I can't really remember when was the first time I've ever heard of this term called inflation, but it was a long time ago, and simply put, it was always about like money eroding away. But I never really thought too much about it. But strangely enough, in the past 6 months, it has been the one word that has occupied so much of the media that I consume. So in today's video, I'll be running through the overview of what is inflation, how it's affecting us as consumers, and then, more importantly, how does it affect our investments? Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest, and feel better about money. So for us consumers, simply put, inflation can be thought of as money losing its purchasing power. Whatever you could buy with $1 before, now you can buy less of today. And a simplified reason of why this actually happens is usually when there's too much money chasing too few goods, which is why the price of those goods goes up. But inflation also affects other assets in our lives. The main ones, for example, are like housing or even stock prices. Now, same principles apply because when you've got too much money chasing too few things, those prices tend to go up. It's actually quite a normal thing, and in today's world, when prices go up by a little bit in a controlled way, it's actually great for the economy. And when you think about it, even for you and me as workers, we want our wages to go up as well, right? There's actually one more way that we will experience it in our lifestyle, and that's not a very commonly talked about thing, and it's called shrinkflation. Like the name suggests, when companies are very reluctant to raise prices because they are afraid of scaring away consumers, instead of raising the price, what they do is they decrease the size or the quality of the thing that you are buying. And usually it's something that's really subtle, so it's hard to notice, and over time it just really gets smaller and smaller, and one day you wake up thinking, hey, wasn't this a little bit bigger years ago? Yeah, you're probably right. But every now and then, you'll see stupid things like this that really piss you off. Now, for those of you who are investors, you might be wondering, how does this term or concept have anything to do with our investing? There's a huge debate right now going on between two camps, the inflationists and the deflationists. The inflationist camp points to the fact that there's so much money flooding the system where governments, especially in the US, have been putting cash into the hands of people. And on top of that, they're pointing to prices of commodities going up, therefore raising the raw material prices of the things that we love to buy. And in an environment where there's too much money chasing too few goods, governments sometimes step in and potentially raise interest rates to cool off the economy. And that's again something that businesses fear because the cost of the loans that they have goes up when interest rates go up as well. So in a nutshell, for corporations, when your cost of raw materials go up, your wages of your employees go up, and on top of that, the cost of your loans go up, everything will hurt your corporate earnings, therefore hurt the stock price as well. And then on the other side, you have the deflationist camp, which believe that the trend of prices of things are actually going down over the long term, and they have been right in the past decade or so. They point to a couple of major things. Firstly, which is the impact of technology and how it increases productivity as a whole. And then they also point to globalization, which is something that the world has experienced, where cost of producing items are reduced thanks to people moving their manufacturing to places where it's cheaper to produce. They argue that whatever inflation that we do see today is transitory, meaning that it will pass. So in case we didn't realize it, COVID has messed a lot of things up in the world, including supply chains. Case in point, my PS5, which I have still not been able to find, and stocks are nowhere near in sight, and I refuse to pay scalpers a premium. So once all these things get sorted out in time, the deflationist camp believe things will go back to normal where prices will continue to trend downward. But the one thing that definitely needs some inflation is that like button, because that really helps my channel grow. Thanks. Isn't all that stuff just happening in America, and how does that even affect us who are living here in Singapore or my friends in Malaysia? Now, prices of things going up affects everybody, and it's not just Americans that are affected by it. It gets much less straightforward when it comes to us as investors. If you've been investing in the US markets, you might be wondering, why are things so choppy? And that's especially true if you've been holding on to certain tech stocks or growth stocks. If you're wondering what the heck is going on, allow me to explain a little bit going back to what happened last year. So COVID tripped up the world last year and made everybody want a refund on 2020. And if you happen to be invested in March of 2020, your eyes would have popped because things just really fell off a cliff. And that's where governments around the world, including Singapore, especially in the US, stepped in like the superheroes they were and did a couple of major things. In the US, they dropped interest rates nearly to zero to spur growth. And then they pumped a crazy amount of stimulus money right into the hands of consumers. So with free money as well as cheap money, stocks became the game to play at that point in time. Specifically, people were betting big on tech names and growth stocks that will not really hurt from the closing of the economies, and those type of stocks also benefit from cheaper money, which are lower interest rates. So that's why at the close of 2020, the Nasdaq was up by about 46%, which is amazing considering what happened to the entire world and the economy. However, starting from November or December, inflation fears began to emerge. It was then when you saw prices of commodities began to rally. But the story of the inflationists really took hold sometime in February, which is when you saw bond market rates really shoot up. And it's then when you begin to see the Nasdaq and tech stocks really fall on their face. Money from those tech sectors really flowed into what you would call cyclical sectors, and these are usually the kind of stocks that benefit from a reopening economy. And ever since then, it's been a tug of war in the media. You have the inflationists saying that, hey, they are right, and then inflation is here and it's here to stay. And then you have the deflationists saying that, don't worry, it will pass, just wait and see. Oh my god, that is a lot of theory, but what is the practical thing that we can do? Let's start with the baseline where both camps are fairly aligned on, which is where you should probably be trying to own some real assets. And this simply means that if you're holding cash in a savings account, right now it's just being devalued over time, and that has been true since the past anyway. Now, bonds in general aren't a great place as well, because right now interest rates are already so low and they are potentially going to go up in the midterm, again depending on who you believe. And in case you didn't know, when bond yields or interest rates go up, bond prices tend to go down. So if you happen to be owning or interested in buying a bond fund or an ETF, that is something that you will probably need to take note of. Now, if you were a more assertive investor, you can choose how to position your portfolio. Now, these are very simplified thoughts, so please do your additional research. Now, option number one is that if you happen to believe the inflationist story, you can position your portfolio by buying more cyclical sectors. These are like financials, energy, or industrials. Option number two is that if you happen to believe the deflationist camp, odds are you are likely already to be tilted towards tech and growth names. So if you're holding on to some of those tech and growth names right now, it's very likely that you're hurting, or at the very least seeing an underperformance of those stocks. But it becomes a point of your conviction. If you believe the deflationists and it's something that will pass, this can be seen as a good buying opportunity, or at the very least just holding on for dear life and waiting till this storm passes. Option number three is that you can totally just go neutral. You don't have to believe any of the camps. Buy a total market fund and just sit back, chill out, and let it play out over time. Now, I elaborated more on my personal portfolio in a previous video, but in a nutshell, I am positioning my portfolio a little bit closer to the inflationist story. So I have a little bit of a skew towards value, as well as some commodities inside as well. Now, from a lifestyle point of view, unfortunately, there's really not much we can do beyond maybe downgrading or choosing brands or products that just aren't as expensive, you can always get a bit smarter with how you shop as well, using the right credit cards, using the right kind of services that save you a bit more here and there. But I think the easier way to approach things is probably to have a age-old principle of living well below your means and hopefully having a modest lifestyle that helps you save a bit more money. And of course, with that money, you should be investing it as much as you can. So thanks for watching, guys. I hope you got value out of this video. And if you did, I would really appreciate your support in clicking that like, subscribe and bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.